Good evening, everyone, and welcome to the weekly Commodities roundup once again. We've had a very quiet week for commodities, especially in terms of metals performance. Despite a lot of key macro data coming into play, we saw that the market has been largely reluctant to actually trend in either directions. This stands true for both your precious and base metals. And one of the key things which we realize over the past 2 weeks is that the market is completely focused on the second stimulus package and the US presidential elections. The second stimulus package comes as a supplement to the initial package, which is known as CARES, and there seems to be a potential standoff between President Trump and Nancy Pelosi in the House of Senate, where there has been a sharp disagreement about the amount of stimulus that is due to be released under this financial aid package. And as you can see that both gold and silver have settled into a broad range. The market has been completely ignoring any source of macroeconomic data or other set of news flows. So I think going ahead, the entire directional move or the short-term trend is completely dependent on this particular event, which hopefully might have some developments through the week. The second important thing is the US presidential elections, which has the potential to affect commodities markets as a whole. Because any change in the presidency will have an impact on precious metals, will have an impact on oil and energy-related policies, which in turn will affect oil and natural gas prices, and also in the relations between US and China, which could also have a potential impact on base metals. So I think the next week is going to be very crucial, week coming ahead in terms of how these events pan out for your precious metals and the market as a whole. We have not seen a lot of change in terms of the situation for your oil prices, especially in terms of the entire demand-supply equation, where demand still continues to struggle given the COVID-19 cases, and supply, even though it has seen a slight dip, continues to remain at rather elevated levels or at levels which is not enough to counter the loss of demand. We also have the OPEC's JMM's meeting this week, which is going to be important for your oil prices, because that should probably give us a fair direction, a fair idea about how OPEC is planning to support the market going ahead. In terms of base metals, like I was telling you last week, we've had the key Chinese trade report earlier last week on Monday, where going by the reports, the demand for base metals, especially copper and aluminum products, continue to remain at record highs. Despite that, we saw that base metals have been largely in a range, especially copper, which, to be honest, has hardly punched a point after the report. I think the market seemingly ignoring this entire bullish event or this bullish trigger could be a potential signal that the entire market or the entire buying has possibly reached a saturation point, and we might see some sort of correction in terms of copper in the short term. Nickel continues to remain a very surprising market, especially catching a lot of people off guard with that entire bullish move. We've been bullish on nickel for a long time now and continue to maintain that perspective. We were telling you a few details through this video going ahead as we will be discussing nickel. But the overall picture from nickel, like I was saying, is entirely driven by that new bull cycle which nickel is entering into, and the physical demand which has been increasing in terms of electric vehicles. Taking both of these into factor, nickel prices have the potential of at least rallying 50 to 60%, possibly in the next 6 months, and that's where we would suggest a lot of short-term investors could park their money. Let's look at the detailed reports along with the performance, and we'll also be discussing a few trading strategies in the following video.
Let's start by having a brief look at the key performers last week. We had a very quiet and sideways market for precious metals, with CME gold losing over a percentage and domestic prices ending the week with a loss of about 0.5%. Silver, on the other hand, lost nearly 3% on COMEX, whereas domestic prices registered losses of about 2%. I think the key thing which we noticed over the last week is that precious metals have been largely reluctant to follow any directional movement, given the regular bunch of macro data that we've had, which clearly suggests that we need something more than the regular data pointers to actually trigger any sort of direction in prices. So I think the focus clearly remains on the second stimulus package and the presidential elections, which are due in November. Oil prices remain steady, with the NYMEX WTI posting a gain of almost 0.68%, whereas the domestic counterpart gained over a percentage over the week. NYMEX natural gas continued to perform, with NYMEX prices gaining 1.15%, whereas M6 prices were higher by almost 2%. Base metals have also had a very quiet week, with lead and nickel being the sole exception. Lead prices lost nearly 4% on LME, whereas on M6 prices lost about a percentage. The sharp jump in LME aluminum prices of over 4%, as you see over here, is because of the sharp gap up that we've had on Monday. But otherwise, through the week, aluminum, zinc, and copper have remained largely steady. Nickel prices continue to perform, with a 3% gain on LME and about a 4% close on MCX. Both the dollar index and dollar rupee remained steady and ended the week with losses of about 0.5% each. We have a busy schedule for macro releases this week. We start the week with four key Chinese reports, which is bound to have an impact on base metals. Industrial production, third quarter GDP, and retail sales should remain in focus. We also have the Bank of China's interest rate decision on Tuesday, which will again see base metals remain volatile through the day, followed by building permits and housing starts on Tuesday evening. We have the usual API report late on Wednesday night, followed by the official inventories report at 8 and the Fed's peach book at 11:30, which should see some amount of impact on precious metals. Unemployment claims, existing home sales data, and natural gas storage report on Thursday, followed by preliminary manufacturing, services, and composite PMI reports on Friday. We also have the Baker Hughes rig count report on Friday night at 10:30 p.m. And tentatively, we also have the presidential debate between the two candidates scheduled on Friday itself. So I think that should also be a key day for your precious metals. Let's move on to the technical outlook now. As you can see from the charts, gold prices are consolidating into the current range, which leads us to think, like I was saying earlier, that despite all the macro releases, the market is completely hinged on the second stimulus package, which seems will be positive for both your equity markets and precious metals as well. So I think that will be the key focus this week, and we should look out for any possible developments on that front. From a short-term perspective, low interest rates, increasing number of COVID cases, and for the stimulus, like I said, both from not just from the US but from the EU as well as on a global scale, which will eventually set the bullish tone for your precious metals rally. So the base case for precious metals continues to remain very bullish. But like I said, unless we don't have a very strong trigger for prices, we don't expect possible rally coming in. Technically, we're keeping a very neutral view and we expect prices to consolidate below the resistance of 50,950 to 51,000. Possible support levels are coming into play at 50,200 to 100. Also, just as a small note, it's worthwhile to keep in mind that any potential, macro developments or any potential event could trigger a very fast buying response in gold, which means that traders need to be on the lookout for any potential breakout or event triggers, because it's unlikely that given the amount of bullish build up or the kind of positive impact that any potential event could have, we might not exactly be getting a lot of chances to jump onto the rally. So it is important to actually keep a track of all possible fundamental developments that are happening. Same goes for silver. I think the lack of momentum in gold prices is keeping silver, confined to this range of 59,600 to 62,400. Technically, we're keeping a neutral view on silver prices this week, and we don't expect any directional move until unless prices are not out of the current trading range. So just to put things into perspective, the basic strategy for this week would be a simple, buying near supports and selling near resistance strategy. Given that we are stuck into a trading range, and unless we don't break out of the range, I think they should be very appropriate. For short-term traders, the lower end of these support levels should act as a good place to start accumulating gold and silver. Also, something which I think would be favorable is trading in call options, because given the current bias which is inclined to the upside, chances of prices moving higher are significantly much more than prices actually collapsing. So call options should be favorable to be trading in this week. We continue to remain neutral on oil prices, and looking ahead, I think the key event this week will be the meeting between OPC and Russia. It's an informal meeting, but any potential come-ins from the member countries could have an impact on oil prices. We also saw the EIA report, the short-term energy outlook report, which was released last week, in which the US EIA is forecasting the fourth quarter of this year to have a deficit of almost 4.1 million barrels per day. This, despite the fact that the demand continues to remain a big struggle, and given the recent drop in production over the last month due to series of back-to-back hurricanes in the Gulf of Mexico, the loss of supply is possibly going to have an impact over the next 3 months. Now, while this is simply a forecast, a lot of things will depend upon how the entire fundamental situation pans out over the next couple of weeks. Fundamentally, I think the situation remains the very same. Demand continues to remain at its lowest level, whereas supply has been more or less steady from countries other than the US. I continue to keep a very neutral view. 2800 to 3050 should be the current range, and we think that the EI inventories might also have some amount of impact on Wednesday. But otherwise, I think it will be a very quiet week for oil prices. Last week, we've had the Chinese import report, like I was saying, which would be very key for precious metals, but it comes in as a big surprise that despite the strong buying from China or import demand from China, we've not seen a similar impact on prices, especially on copper. Copper concentrates, the demand for ore and concentrates were up by almost 35% on a yearly basis, whereas unwrought copper has seen an increase of almost 68%. And despite that, as you can see, prices are trading into a range of 523 to 532. We're keeping a neutral view on copper prices through the week, and I think from a intraday or from a 2 to 3 day perspective, until we don't have a breakout from the range, we don't expect any key significant developments on the copper front. For short-term traders or for positional traders, I think given that prices are consolidating into a neat range, this provides a very good short-term trading opportunity, especially if prices close above the resistance or below the support. It should probably result in a good 10 to 15% swing in prices. Nickel continues to remain a star performer, and like I have been telling over the last couple of weeks, we were expecting prices to move higher, and things have panned out that way. So, like I said, the entire bullish case for nickels comes completely from the fact that EV demand, even though it is not visible because the figures are not easily available, the demand for electric vehicles is increasing on a global scale, and not just nickel, but all the base metals continue to see a very strong physical demand. So starting for the from a short-term perspective, I think we still have a lot of upside for nickel. Immediately, I think over the next 2 to 4 weeks, expect nickel prices to actually rally further to 1180 to 1200, and we would be advising buys in the short term. So from a technical view, I think it is very important that prices close above the immediate resistance at 1155 to 1158. Once we have that, I think buy positions could be entered for targets of almost 30 to 40 points and possibly 1222 before the year ends. On the lower side, in case if we do have any sort of profit booking move, in case if prices fail to break the resistance, we might see prices head back to 1135 to 1125 odd levels. But again, that should be seen as a good buy on dips level for your nickel prices. That's everything on commodities for the week ahead. Thank you for watching and happy trading.